If this is the market cap of the worldwide stock market, this is the market cap of the worldwide bond market, and this is the total notional value of the financial derivative in the world. Hi everyone, I'm Mr. Te from The Modern Reminder. When we talk about financial market, usually it is the stock market and bond market that comes into our mind. But there's also another market that makes up a big part of the financial market, which is the derivative market. It is less known to retail investors due to its complexity. And derivative market is what we are going to talk about today. Derivative market is not an easy topic to talk about compared to stock market and bond market. So as usual, I will try to explain it in a simple and hopefully not too boring way. If you look at the definition of derivative given by Investopedia, without any context, it's hard to understand what is it talking about. So I'm going to give you some examples, and hopefully from these examples, you can understand the concept of derivative. In previous video, I used the example of milkshake to talk about stock market and bond market. If you haven't watched it, you can click the link below. So today, I'm going to use the same example to talk about derivative market. You own a milkshake company, so the milk is the main ingredient of your product. It makes out of 30% of your total production cost. And for whatever reason, you think that the milk price is going to go up in 2 months' time, and that will seriously affect the profitability of your business. Well, you can't buy and store the milk now because of its shelf life. But even if you can, you don't want to spend that much capital stuck in your inventory. So what can you do? Say you have been buying milk from Uncle Lloyd. You can get into this contract with Uncle Lloyd. Say to buy 5,000 liters of milk at 2.2 ringgit per liter 2 months from now. In this case, you lock in the price of the milk today. And why would Uncle Lloyd agree to that? Because he might worry that the price of the milk might go down, and 2.2 ringgit per liter is good enough for him. So I got into a financial contract with Uncle Lloyd, and our underlying asset is the milk. Since I got into this contract with the expectation that the price of the milk will go up, I am long in the position. And Uncle Lloyd got into this contract with the expectation that the price will go down. He is short in the position. Say 2 months from now, the milk price go up to 3 ringgit per liter. It won't affect me. I'm still going to get my milk at 2.20 per liter from Uncle Lloyd. So I got into this contract with Uncle Lloyd without going through an exchange, which means over the counter. And when this sort of contract is done over the counter, it is called the forward contract. What is the problem with forward contract? It's obvious. First of all, Uncle Lloyd might not want to deal with this kind of nonsense. And even if it does, it's not easy to agree on a price at certain quantity on a specific timeline. And even if you can agree on all of this, how can you be sure that Uncle Lloyd is going to honor the contract for sure? All of these problems that I've just mentioned can be solved when there's an exchange involved. Because that's what exchange does. It's facilitating the buyers and sellers. That is why it is called an exchange. So futures contract is basically forward contract with an exchange. You can still loan the milk, but the counterparty is the exchange. Of course, on the other side, there's someone shorting the contract, taking the opposite position of yours. But who is that? You don't know and you don't care. Now you might think that this is not practical. The milk futures is traded on Chicago Mercantile Exchange. How are you going to receive milk all the way from Chicago? Even if that can be done, you prefer to buy it from Uncle Lloyd because you like it fresh here. Well, this is how it can be done. Don't forget that futures are traded on exchange. So it means that you can trade the futures to hedge against your position. Back to the same example. The milk is currently trading at 2 ringgit per liter, worrying that the milk price might go up a lot in 2 months' time. So you go long in the milk futures to buy 5,000 liters of milk at 2.2 ringgit per liter 2 months from now. 2 months later, if the milk price is trading at 250 per liter, you can sell the contract and profit 1,500 ringgit from it. At the same time, you continue to buy milk from Uncle Loy at the market price, which is 5,000 litre at 250 per litre. So your cost would be 12,500 ringgit. Well, you still end up buying expensive milk, but the money you make from futures will offset your purchase cost. Thus, your effective cost is 12,500 minus the 1,500 profit you made from futures, equal to 11,000 ringgit, which is 2.2 ringgit per litre. Of course, if the milk price goes down, the opposite would happen. This is called hedging. Because we can trade futures contract, therefore making money or losing money from them, so it enables speculation. In fact, most of the professional traders, they trade derivatives. Why do derivatives entice speculators? First of all, unlike stock and bond, derivatives, they are not assets. Derivative is just a financial contract where its value is dependent upon the underlying assets. In our example, it is milk, but it really can be anything else. It can be coffee, it can be oil, it can be soybean, palm oil, gold, silver, interest rate, bond, stock, you name it. Heck, it can even be weather. Sounds crazy, but you can make money by predicting the weather. So there's a lot of variety in there. The second reason is the leverage features in derivative. Recall our first example where you got into this contract to buy 5,000 litres of milk from Uncle Loy 2 months from now. Do you pay the full amount to Uncle Loy? No, because you haven't received the milk yet. Makes sense, right? You only have to pay the deposit. Future works in the same manner. Usually, you only have to pay 5 to 20% of the contract amount. And this leverage feature of derivative amplify the risk and return, therefore make it attractive to the traders. Here is an example of using derivative to speculate. Let's say Alphabet stock is trading at $100 per share. You have 5,000 US dollar, you can buy up to 50 units of Alphabet share. If the price of Alphabet goes up to 120 US dollar, you will make 1,000 US dollars. While with CFD, which is a type of derivative, Alphabet being the underlying asset, you only need to place 10% of the contract amount. So with the same 5,000 US dollar, you can buy up to 50,000 US dollar worth of contract. That is 500 units of Alphabet. If the price of Alphabet goes up to 120 US dollar, you will make 10,000 US dollar, 10 times of your profit if you use cash. Of course, I have to warn you again, if the price falls, you will suffer more with derivative. Whether you are using derivative to hedge or to speculate, you get the idea that derivatives are more attractive during uncertain time. Look at this report on Singapore Stock Exchange. It mentioned that the derivative business improved, driven by the conflict in Russia and Ukraine. Now we are back to the definition of derivative given by Investopedia. First, derivatives are financial contracts between two or more parties. In our example, it could be you and Uncle Loy, or you with the exchange with another counterparty on the other side. These derivatives, they derive their value from an underlying asset, group of assets of benchmark. In our example, the underlying asset is the milk. And second, a derivative can trade on an exchange or over the counter. So when you struck a deal with Uncle Loy, it is called over the counter. And when you buy the milk futures through the Chicago Mercantile Exchange, it means you trade it on an exchange. Third, the prices of derivatives derive from fluctuations in the underlying assets. As you can see from our example, when you long the milk futures and the milk price goes up, you make money from it. Fourth, derivatives are usually leveraged instruments which increase their potential risks and rewards. And you can see this in the Alphabet example. When you buy Alphabet through the CFD derivative, you make much more money when the price goes up. Of course, if the price goes down, you will lose much more money. Common derivatives include futures contracts, forwards and options, and swaps. We have already covered futures contract and forwards, and we will do options and swaps next. Bear in mind that forwards and futures contract, they are not equivalent to derivative. They are only types of derivative. Perhaps in the simplest form, I'm only using them to explain the concept of derivative to you. Now we can move on to the next type of derivative, options. As the name suggests, options give you the option, the right, but not the obligation to execute the contract. Use the same example. For whatever reason you think that the milk price is going to go up in 2 months' time, you got into this option contract that allow you to buy 5,000 liters of milk at 2.2 ringgit per liter. And when the option contracts allow you to buy the underlying asset, it is called a call option. And then the price you can use to buy the underlying asset, in our example, is 2.2 ringgit per liter of milk. That is called the strike price or the exercise price. 2 months from now, if the milk price is trading at 250 per liter, the option is called in the money. It means that the price of the underlying assets is favorable to the option holder. You will then execute your option to buy that 5,000 liters of milk at 220 per liter. And what if the milk of the price doesn't go up, instead it started to drop to say 2 ringgit per liter? In this scenario, the option is called out of the money when the price of the underlying asset is not favorable to the option holder. In this scenario, are you going to execute the option? Of course not, because option give you the right, not the obligation. So you just let the option expire. From another perspective, what if Uncle Loy want to protect himself with option? He can then find an option that allow him to sell the milk at certain price. If the option allow you to sell the underlying asset at certain price, it is called put option. It's the same thing, only the other way around. Now you might ask me a question. If there is something as wonderful as the option contracts that give you the right but not the obligation to buy or sell the underlying assets, why would people still go for futures or forward? The reason being, when you go into the options contract, you have to pay premium. You see, in futures or forwards contract, there are no charges involved except for some handling fees, trading charges, and your position to buy the milk at 220, to use our example, is offset by Uncle Loy position to sell it. But in options contract, it is pretty much like buying insurance. You have to pay premium to the issuer. Who is the issuer? It's not Uncle Loy, but the investment bank that issue the options. So if nothing happen, your premium will be burned. Something happen, you get paid. Now you see how you can protect your business with options contract. But can you speculate with option contracts? Of course you can. In fact, there's an asymmetrical features in options trading that makes it very interesting. You see, when you trade futures, theoretically speaking, your downside is unlimited, your upside is also unlimited. But in options trading, the upside is unlimited, the downside is limited. And because of this, I usually advise people to go for options trading if they want to try to trade derivative for the first time. The risk is still high, but at least it is so much lower compared to futures trading. Now let me give you an example of using options contract to speculate. If you have been in stock market for a while, it is no stranger to you. All these structured warrants listed on Bursa Malaysia are in fact options. How are they options? Let us examine them together. Now look at this call warrant, Tenaga C1G. In fact, it is a call option. The call option is trading at 17 cents. It allows you to buy Tenaga stock, which is the underlying asset, at the exercise price of 8.08 in a period of 7 months. The premium you pay is also stated here. We want to keep the premium as low as possible because that is the extra that you pay for this option. The issuer of the option is Maybank Investment Bank. If Tenaga is trading above 8.08, the warrant is in the money. Otherwise, it is out of the money. The exercise ratio of 6:1 means that you need 6 units of this option to convert into 1 Tenaga shares. Of course, you don't actually convert it because it is done through cash settlement. I don't want to get too technical in this video because this is supposed to be an introductory video. Maybe we will go to the calculation in the future video. But what about the asymmetrical feature that I talk about? The limited downside, unlimited upside. Now look at this chart together. You see the exercise price of 8.08 per warrant, right? If the Tenaga closed at the exercise price of 8.08 or below, the amount you will lose is 17 cents per warrant. You can't lose more than this amount because this is 100% of your capital, which is the price you paid for the warrant. And to calculate your break-even, you use 17 cents times 6 because the option is 6:1 plus the exercise price of 8.08, you get 9.10. If the Tenaga closed at 9.10, you break even, and whatever price beyond 9.10, that will be your profit. In that sense, the maximum amount you can lose is 17 cents per warrant, and the profit, as long as the price crosses the 9.10, there's no upside limit for you. Therefore, the risk and reward are asymmetrical. The premium of the warrant is already included in the 17 cents, which is the price of the warrant. So the higher the premium, the harder for you to break even. So you want to keep it as low as possible. The same goes with put option, but in put option, the chart is the other way around. Now let's move on to the last type of derivative, swaps. Swaps usually they are not traded on exchange because they are primarily over-the-counter products. And because they are over-the-counter products, usually the amount has to be big enough in order for the investment bank to construct a deal for you. So usually they are not for retail investors. Say years ago you took up a huge loan for your milkshake business at a rate of base rate plus 2%. And recently the central bank keep on raising interest rate. The base rate is now 3%. So effectively you are paying 5% per annum. You still can afford 5%, but that is about the highest you can pay. And you think that the interest rate is going to go up more in the future, and at that time you might not be able to pay the interest. What can you do? In such circumstances, you want to lock your interest rate at 5% per annum. So you find a counterparty to swap the interest rate of the loan. If you are currently paying variable rates loan and you want to switch it to fixed rate loan, the investment bank could find a party who wants the opposite. Let's say the counterparty is called Company A. So you got into this swap contract with Company A. You agree to pay Company A 5% interest rate per annum, and Company A would pay you base rate plus 2% interest rate per annum. Now let's see how it plays out in these 3 scenarios. In the first scenario, base rate stays at 3%. So you pay the bank 5%, you pay Company A fixed rate of 5%, and Company A pay you 5%. You are effectively paying 5% per annum. In scenario 2, base rate drops to 2%, you pay the bank 4%, you pay Company A fixed rate of 5%, and Company A pay you 4%. You are effectively paying 5%. In scenario 3, base rate goes up to 4%. You pay the bank 6%, you pay Company A fixed rate of 5%, and Company A pay you 6%. You are effectively paying 5% per annum. So in all 3 scenarios, you are effectively paying 5% interest rate per annum. So you achieve what you want, to lock the interest rate at 5. In this example, I use interest rate, but it could be other underlying assets like currency, inflation, stock, etc. Now let's do a summary. What is a derivative? Derivative is a financial contract between 2 or more parties, and the value of the contract derived from the underlying assets. A derivative can be traded on exchange or over the counter, and they are usually leveraged products which increase their potential risk and rewards. That's why traders like them so much. Forward, futures, options, and swaps are the common example of derivative products. Before I finish today, I must warn you how deadly can derivatives be. Derivatives are known to be the most notorious financial instrument. Warren Buffett called them financial weapons of mass destruction. They certainly play a big role in the financial crisis 2008 and the fall of Deutsche Bank in 2018. If you want to get into the details of that, you can watch the documentary The Big Short if you want to know more about the financial crisis 2008. And if you want to know more about the fall of the Deutsche Bank, you can read this book, Dark Powers. Why are they so dangerous? The reason is twofold. First, it is the leverage features in derivatives. That is the obvious one. And second, derivatives are just financial contracts. From the issuer perspective, if you want to issue bonds, if you want to issue stocks, there must be an entity seeking to raise funds. But for financial contracts, as long as there's demand, there's profit to be made, it can be created out of the thin air. And from the trader's perspective, the position of derivatives are easier to be manipulated. Why is that? Remember, as financial contracts, they don't appear on balance sheet because they are not assets nor liabilities. So it is more opaque. And because of these reasons, the issuers and the traders can easily lose sight of the potential risk while pursuing profit. It sounds cheesy, but I have to say this. Yeah, derivatives, they can be very dangerous. They can be the financial weapon of mass destruction. But like all weapons, they are just instruments. They don't have free will. What pushes us to the mass destruction is our unchecked greed. So if you are interested in one-stop financial services, be it stock, bond, unittrust, PRS, derivative, click the Google link below and my team will get in touch with you. If you like this video, like, share, subscribe. Until next time.